Hi, Gabriel Josiah here again. Right now, we are diving into the cash operating cycle. Cash operating cycle is also known as cash conversion cycle, a vital metric in evaluating a company's operational efficiency in converting investments back into cash. This isn't just an exam topic, it's a real world tool that impacts everything from cash flow to strategic decision making. Join me as we break down how to analyze and optimize this cycle to improve both exam readiness and on the job performance. Let's delve into this quickly. Let me share my screen like it's our custom, and let's look at this ratio very graphically. So if you can see my screen, we'll be describing the cash conversion cycle, which is also known as cash operating cycle. It measures the time it takes for a company to convert its investment into inventory, accounts receivables into cash flow from sales. This is very important. This metric helps businesses understand the efficiency of their operations in managing cash flow and working capital. A company's operating cycle is the time it takes for the company to convert its investment in inventory back into cash. It considers the number of days the company ties down into cash in inventory, so it has invested in inventory before the cash is realized after collection of receivables. The operating cycle of a company that manufactures or sells goods comprises of 4 phases, and we'll look at them as follows. We have the raw materials stage. We also have purchases. That means raw materials are purchased and goods are produced and kept in the store as inventory. Now, goods are sold from inventory to generate sales, which may be on credit, in cash, or both. So, they also extend these credits to customers, which leads to accounts receivables, that is, debtors traditionally. The account receivables are collected to also generate cash. So you can see the cycle is moving. However, for a company that only buys goods to resell, the first phase, which is raw materials, above that we just looked at in the previous slide, will not apply graphically here. Its operating cycle will only involve the last 3 phases. So the same thing applies to a company that only renders services to its customers or clients. Operating cycle is normally measured by number of days in each of the phases listed above. For example, the number of days the funds of the company is tied up in inventory is measured by the total fund invested in inventory or stock and the average days of cost of goods sold. Usually the funds tied up in inventory is represented by the closing inventory shown on the company's position statement at the end of the financial year. However, it is felt that the average fund invested in both the cost of inventory at the beginning and at the end of the financial year is more representative of funds tied up in inventory during the year. Both methods of calculating the number of days funds are tied up in inventory are, however, acceptable. So the average days cost of goods sold is the cost of goods sold on average daily in the year, which is measured by dividing the cost of goods sold by the number of days in the year, which is typically 365 days. So the number of days in the year is normally taken, like I said, to be 365 days unless otherwise stated. Therefore, the number of days funds are tied up in inventory is calculated as follows. So we have it as number of days in inventory, which is inventory as your numerator, and you have the average cost of goods sold per day as your denominator. And this culminates into the average inventory, which is your cost of, the denominator is your cost of goods sold times 365 days in a year, to have the number of days it takes to tie your inventory down and convert them into cash. This is very important. In the same way, we can calculate the number of days funds are tied up between the time goods are sold on credit before cash are received from the trade receivables, or the debtors as we call them. The account receivable in the statement of financial position at the end of the financial year is used if this is representative of receivables during the year. So you have the beginning account receivables like we saw in the receivable collection period example in the previous video. We have the ending receivables. So both of them will get the average of it to be able to express how much is the average to get our credit sales and express it by 365, like we saw graphically with an example in the last or the receivable collection period video. Otherwise, the average accounts receivable at the beginning of the year and at the end of the year would be used. Now, we calculate the number of days for receivables as accounts receivable divided by the average days of sales on credit, which culminates in your average accounts receivables beginning and ending divided by 2, and you have the denominator as your credit sales times the year, which is 365 days typically. Now, thirdly, you have the accounts payable in the statement of financial position at the end of the financial year, which is also used if this is representative of payables during the year. Otherwise, the average accounts payable at the beginning of the year and at the end of the year can also be used. And in the last examples, last example we saw with the trade payables period, you could see the average payables, which is our trade payables for the beginning, was what was used, and at the end, we added them together and divided them by 2 to have the average accounts payable, which is what is the accurate calculation of the trade payables period for the year. Now you could see the formula on the screen. You have the accounts payable and the average days of purchases on credit. Now it culminates in the average accounts payable divided by the purchases on credit times 365 days, which is a year typically expressed. So we've seen with the trade payables period example and the calculation we made with this scenario, we painting graphically on the screen. So the formula now, looking at the 3 of them, the inventory holding period, the receivables collection period, and the trade payables period, we now have that as the cash operating cycle or the cash conversion cycle formula, which is your inventory holding period, which is positive, your receivable collection period, which is added to your inventory holding period, while your trade payable period will be deducted to have your cash operating cycle or your cash conversion cycle. So let me take that again. Your inventory holding period, which is your positive current asset item. You also have your receivable collection period, which is your positive cash, your current asset items added to your inventory holding period. Then you deduct your trade payables period from the 2 of them to have your cash conversion cycle. So the trade payable period, it's the current liability item, which is a minus or a deduction from this. So what does this mean? It means that the number of days it takes for a company to turn its inventory into cash, accounting for the time taken to collect receivables and the time allowed to pay suppliers. This is very important. So let's go back to the formula again and use the formula, which is the inventory holding period plus your your receivables, I beg your pardon, receivable collection period, deducting or minus your trade payables period. So let's use that shall be 2 example we've calculated for the first 3 periods. So let's go back to our calculation. And you'll see from the inventory holding period, we have it as 120 days. So let's pick that for inventory holding period. So I have it here as inventory holding period. So which is, we'll pick it, let's pick it as inventory holding period and copy it here. So, beg your pardon. Good. So we have it as 120 days and not value. So let me remove the side. So we have it as 120 days for our inventory holding period. Now let's get our receivables collection period, which is expressed here as 529 days. So our receivables collection period is 529 days. Now let's get our trade payables period also from what we've calculated. We have it here, and you can see our trade payable period is 200 days from our computation. So what is our cash conversion cycle, which is also known as our cash, let me go back to the formula now, which is our cash operating cycle, cash conversion cycle, or our cash operating cycle. So let me say COC here as cash operating cycle. It's the same thing. Okay, so in calculating this, it's very simple. So we have it as our inventory holding period plus our receivable collection period minus our trade payables. Very simple. So express that, and on average, it takes this company, Sharubutu Nigerian PLC, like we see in the example, Sharubutu Nigerian PLC, takes this company 448 days, approximately 449 days, to convert the cycle into cash. 448 days. This is quite high and alarming. So what does that mean? It indicates, like we said, the number of days it takes the company to convert inventory, average receivables, and also pay suppliers. So that cycle is 449 days approximately for the company we send. Now, a shorter cycle suggests efficient management of inventory, receivables, resulting in quicker cash generation. So shorter cycle is better. A longer cycle depicts the opposite. So what's the implication? A shorter cash operating cycle is generally favorable as it implies that the company can quickly convert its resources into cash, enhancing liquidity and reducing the need for external finance. Very, very comprehensive. While a longer one indicates inefficiencies in managing inventory, like we've seen, receivables, which could lead to cash flow problems. So typically, the general recommendation is to have it as 30 days, 45 days, maximum 60 days. So when you have 448 days, 449 days, like we saw in that example, then it depicts their cash flow problems. It's a longer cycle from our example, and it shows there are problems with managing inventory, receivables, and payables. What is the cause and effect? A short cash operating cycle is caused by efficient inventory management, quick sales processes, effective collection strategies. This is very important. While the effect is improved cash flow, reduce reliance on external financing, because when you have shorter cash operating cycle, you are able to optimize operational efficiency. Now, longer cash operating cycle or cash conversion cycle, like we saw in the example, shows that there are excessive inventory levels slow moving goods, delayed collection, and lenient credit terms for customers. So these are the causes. What are the effects? Cash flow constraints are the effects of a longer cash conversion cycle, potential liquidity issues, and increased costs associated with financing operations. This is critical. So in conclusion, the cash operating cycle is a critical metric for assessing a company's operational efficiency in converting investments into cash. So management should monitor this cycle. Businesses can identify areas for improvement in inventory, receivables management, payables management, optimize cash flow, and enhance overall financial performance. This is very, very important. So in summary, the cash operating cycle gives you a powerful look at how efficient a business can turn its investment into cash. Shortening this cycle means stronger cash flow and more operational agility. A key objective for finance team and leaders. Thank you for watching. And if you found this useful, hit like, subscribe. Stay tuned for more insights on cash flow and operational performance. Keep pushing your skills to the next level, and see you in the next section. Until then, bye for now.